Hi students, welcome to SDMIC classes. My advice to you all, nothing is impossible for a brave and hardworking person with a willing mind. Be prepared, strong enough. Chapter 1, Introduction to Partnership and Partnership Final Accounts. This is part 3 video. Chapter 1, part 1 and part 2 video is already uploaded. Hope you must have watched those previous 2 video classes. I believe you all must have understood. I request you all to pay attention. Now, before just go to the next class, before just starting this third part, we will just see what we learned in the last 2 videos, just a revision, so that your memories will be more powerful, and you can just learn it very easily. So we will just go through again what we learned in the last 2 videos, then we will go to the third part. Okay, let us see what we learned in the previous 2 videos. In the first video we learned this, what is introduction to partnership and partnership account, what is a partnership business, and what is means a sole proprietorship, and what is a partnership business, and why partnership is formed, what is the benefits of partnership, meaning of partnership, definition of partnership. This we have learned, and then I hope you must have understood this. Now let us see this the second part. This also we have learned features of partnership, this agreement, number of partners, lawful business, sharing of profit and losses, unlimited liability, registration, joint ownership and management, principal and agent, now dissolution. And this 9 points we have discussed as features of partnership, and this we learn in this first part, and this two part we learn in the this introduction and all this meaning and the definition, etc., and also these features we learn in the first part. And the second part we learn partnership deed. What is partnership deed? The document containing partnership agreement among partners is called partnership deed. An agreement may be written or oral, but when it is written, it is called a deed, partnership deed. An oral partnership deed doesn't have any legal value, whereas a written partnership deed registered under the registrar of firms is having a legal validity. So these points we have learned, and the contents of the partnership deed. These 11 points we have learned, and then the importance of partnership deed. What is the importance of partnership? Why a partnership deed must be made in written? Partnership deed means a written agreement among of the consent, means this agreement among the partners. Terms and conditions agreed among the partners is written in a document and registered is called a partnership deed. And what is the importance of that? That is also we explained. These 2 parts we have explained in the second part. Now then we learned provisions of Indian Partnership Act 1932. So why the partnership deed is a written document prepared at the time of formation of the partnership, mentioning all the terms and conditions required. जो भी partnership partners को जो भी required terms and conditions है, उसको written document और एक written document बना के register करते हैं, that is a partnership deed. वो Indian Partnership Act 1932 का under registrar of partners, registrar of firms में register करता है. We learned that what is a firm. तो registrar of firms means जो partnership business को firm बोलता है, and the partners, the owners को बोलते हैं partners, and the business of partnership is called a firm. So that we learned. So provisions of Indian Partnership Act 1932 also we learned, and what are the conditions. Suppose if it is not any condition, terms and conditions are not mentioned in the partnership deed, then this registered partnership firm, these following terms are automatically taken by the ruled and resolved by Partnership Act 1932. So, what are the things? If it is not mentioned in the partnership deed, then these terms are applicable, these conditions are applicable. One is distribution of profit, second interest on drawings, third interest on partners loan, interest on capital, salary or commission to partners, admission of a new partner, then continuity of partnership. So, these 7 points we explained in the last part 2 video class. Now, let us move to the other part. I think you have already you understood this. I explained in detail. So, it is not necessary to just just explain again and again, that because that is a loss of time. So, we don't want to do that again and again. So, now I want to tell you means, if you don't understand that, now if you don't get it, just go to the just read that past part 1 and part 2 videos again and again, watch again and again, you will get it. So, because I explained in a thoroughly. Now, let us move to the other part, part 3. Now, in this part 3 video, we explain methods of capital accounts. Now, capital. What is capital? I have explained in the previous part 1 slide also video. This capital we have explained in 11th standard also, when the proprietary concern, when it came, and the terms when we learn what is capital, what is means there are some terms and concepts we have learned in the first year, means FYJC 11th standard we learned that, and we explained capital also. But in the previous slide, previous part 1, I have explained that. Part 2 also we explained what is capital. So, a person who individually put a money is called a proprietor, that we explained. Now, when we are saying that what is a capital, amount of cash or value of materials in kind brought in by the partner to manage business activities is termed as capital. The persons to start a business and to run the business, the person put his money, the owner put his money. So, if individual person, if he put the money, it is called a proprietor's capital. But if that amount does not sufficient, then more than one owners, more than one person come together and put their money and they run the business, that is called a partnership firm, a partnership business. So, now if the capital of the partners are the partners put the money or bring the money or material, that value of the material is taken as a, see, it is not necessary that cash must be produced, must be brought into the business. Suppose if a person having some furniture or a place, he say that my contribution is this big place, premises, and that we can use for our business purpose. So, that value of the property or some deposit type or rent type or whatever it is, means what is the value we assess, that will be taken as the capital. Or some person may say that I have the machinery or I have some other things, furniture, whatever it is, they bring that material brought in kind is also termed as a and that value will be assessed and that value will be taken as a capital. Or so, now you understand that now amount of cash brought by the partners or the value of the materials brought by the partners into the business to manage and run the business, to start and to manage and run the business is called capital. You got it? Now, the amount of cash or value of materials in kind brought in by the partner to manage business activities is termed as capital. The partners maintain and operate some methods. So, in partnership, the capital accounts are maintained in 2 different ways. So, that we will explain, and also I will just give some examples also, working examples also, that will clear your the concept and how to manage that, how to maintain the capital accounts of partners. So, now let us see. So, methods of capital account. One is fixed capital method and the other one is fluctuating capital method. Under fixed capital method, there are two types. One is capital account, there is a fixed capital account and a current account, a partner's current account, current capital account. And in a fluctuating capital account, there is only one capital account that keeps fluctuating. That the term itself says that it keeps fluctuating. Whereas in fixed capital method, there is a capital method, this is a fixed one. This will not change. Whatever we put in the beginning, that will remain at the end of the thing. Whereas the current account, what the remaining the current year's operations are handled, or that transactions are passed through this current capital account. And whereas in fluctuating capital account, there will be one account maintained. Here two accounts are maintained. In fixed capital method, two accounts are maintained, one fixed capital account and a current account. Whereas in fluctuating capital account, there is only one capital account is maintained. That keeps fluctuating. The concept will be more clear when we just explain and just show the examples. Now, methods of capital account. Fixed capital method. In this method, amount of capital of a partner remains the same at the end of that financial year. There won't be addition or subtraction from the capital during the year. See, the addition means if they want any additional fund to be put, that can be added. Or whereas means there is no drawings or means any other activities are not added into that. So what I am telling that means that in the fixed capital method, the amount of capital remains constant, remains same at the till the end of the year. So there won't be any changes happening. So when this method is adopted, when this fixed method is adopted, then the partners has to maintain a partner's current account just to do the current year's transaction. Like for example, some drawings may be there, some interest may be there, some commission or salary may be there, some other activities may be there, some withdrawals may be there. So some additions will be there. These things are done. These transactions are done through the current year's transactions are done through the current capital account. When this method is adopted, partners open a new account in the name of partner's current account, and all the related capital adjustments are done or sold through partner's current account. That means whatever during the current year's transactions are there in the partner's related capital account, that will be done through this current account, partner's current capital account. So now see working notes, fixed capital account. So let us see. There will not be any change in the capital account during the accounting year. This is a fixed capital account. So the balance what is brought down, if it is 1 lakh by partner A, 2 lakh by partner B, then this will not change. This will be carried forward as it is. But if there is an addition, then that will be added. Means addition of fund if it is required. It's a very big fund, not small funds or anything. If there is any requirement is there then. But normally this won't happen. So the whatever is the balance means the starting jo balance hai, that will be carried forward to the next year. That will be brought down carried forward to the next year. This will be carried at the end of the year and that brought down at the beginning of the next year. So the journal entries will be cash or bank account debit to, if it is starting, cash or bank account debit to partner's capital account. So when the account is when the amount is brought in by the partners for the assets लाया रहेगा तो then what will happen? The particular assets account debit and partners capital account. For example, if it is a machinery, the machinery account debit करेगा, then उसका value of the amount will be debit to the, suppose if it is a machinery account, and then that amount will be credited to the partners capital account. So this is the fixed method. Now current partners current account, partners current account. So here the balance brought down, suppose if it is a beginning or if it is starting, there won't be anything, this will be 0, and if there is a loss in the previous year, that will be brought down here, means there is a deficit. It's not say that loss, it's a deficit in the current account. Suppose if there is a deficit, it will be brought here, or if there is a surplus, it will be brought here. Brought down to the current credit balance and debit balance. So credit balance is there, it will be brought down here in this current account. So then the adjustments are here. The transactions means that interest on capital account paid here to the partners, salaries paid to the partners, commission paid to the partners, and if there is any profit, the profit will be added to here, not into the fixed account, fixed capital account, whereas it will be taken to the current account, current capital account. So this will be added, and out of that any drawings are there, that will be means debited, and interest on drawings will be debited. Then if there is any loss, in case if there is no there is in the business there is no profit, there is a loss, and thus loss will be debited to the partner's current account. So if then out of the total of the means this credit balance, balance, the debit items means whatever is the जो है, that will be deducted and the balance will be carried forward. Suppose if there is a deficit, that will be taken here in the credit side, means so the debit balance will be taken here, and if there is a credit balance, will be carried forward from here to the debit as it is taken. So if there is a credit balance, it will be brought down here. If there is a debit balance, taken to the debit side. So means the next year 1st April it will be taken here. This will be the balance will be carried forward at the end of the year 31st March. So then it will be brought down to the next year. So hope you understand this concept. Now we will just see fluctuating capital account. We will just learn. Let us see so partner's current account. We already see that partner's current account. When a partnership firm adopts a fixed method, then a separate account is opened as partner's current account. In this account, all adjustments related to capital accounts are recorded. This already we have seen. Now drawings made by partner in the current accounting year. This is for the current year. The term itself is used as current account. Current partner's current account, that is current year. Current year means that's 12 months for the accounting year starting from 1st April to 31st March. So during the current year, whatever the drawings are made, that will be taken, and goods or any assets taken over by the partner, and then interest on partner's capital allowed by the firm, then interest on partner's drawings charged by the firm, and salary, commission, etc. payable to the partner, distribution of profit or loss of the firm. These adjustments are taken to the current account. This we already seen that. Let's see again. This is the thing. See, interest on capital, salaries, commission. Then if there is any loss, it will be taken here. And if it is a debit balance, it will be taken here. But opening balance, then the drawings of the partner during the current year, and interest on the drawings charged by the firm to the partners is debited to here. And then if there is any loss, it will be taken. And if there is a surplus, it will be carried forward here. Credit balance, if there is a debit balance, it will be taken to the here in the credit side. So the credit balance will be, if there is a credit balance, will be carried forward here. So now I think it is clear. Now let us move to the other part. When we will solve the example, then you will come to know. It will be clear. Now methods of capital accounts, we continue that. Now fluctuating capital method. In this method, amount of capital balance changes every year. Means the firm maintain only one capital account for individual partners, but only one. There is any separate fixed capital and current account are not maintained. Only same. All the adjustments and everything is done in that particular current this capital account only. But individual partners accounts are maintained separately. But in this method, amount of capital balance changes every year. This type of maintaining partners capital account is called a fluctuating capital method. The term itself says it is fluctuating. That means that balance means and the amount of capital plus minus will be happening. Means whatever the transaction like commission, salary, etc. and withdrawings, and that will be adjusted and the balance will be carried forward. So there won't be any separate account maintained. Only one account of the capital account is maintained. These are easy, and some means just individual means that in individuals is a small professional accounts are maintained in this way. In this method, partners capital account is not opened, hence all adjustments are sold through this single capital account. Already explained that. Now following are general adjustment related to capital account. One, initial or starting of the year, the funds, if it is starting, then they bring the business, then it is with cash or bank, and if it is a means the previous year's balance brought down, then it is opening balance, opening capital brought down, opening balance brought down. Then additional capital brought in by the partners in the cash or kind. Then interest on partners drawing charged by the firm. Then salary or commission paid or payable to the partner. Then interest paid or payable on capital balance to the partner. Then drawings made by partner during the year. Then withdrawal of part of the capital by the partner, or distribution and transfer of net profit or net adjustable loss of the firm to the partner's account. So these points you should have to keep it in mind. When you do few sums, it will be very easy. It's not complicated. It's a very simple thing. Very simple thing. So when you take it that way, you approach in that way, it will be very easy. These points you have to just make very clear. You have to learn very well. And these are not complicated thing. So now let us move to the other part. I will just show you the example of means fluctuating capital method, partners capital account, fluctuating capital method mein, if it is starting, then cash or bank. If it is a previous year balance, there is a balance, that balance will be brought down here. If it is a credit balance, if it is a debit balance, it should be brought down here in the debit side. If it is a credit balance, it will be brought down to the credit side. The credit balance will be brought down to the credit side. This credit balance indicates surplus, debit balance indicates deficit. There is no balance, it is a deficit. Normally this will not happen, but very rare cases. But whereas in current account it is possible. In this method this is not possible, means debit balance is not possible, credit balance is possible, but in rare cases it can, because the firm goes into deep losses, then that is possible. But otherwise, if it is in a normal running business, it is not possible. There will be always a credit balance. Whereas in current account it can be possible, because current account fluctuate here and there, means the small adjustments and all there. If there is a continuous loss for 1 or 2 or 3 years, and if it is more than the opening balance of the current account, then there will be a possibility of debit balance. Otherwise, it is mostly always when business is doing for the profit, then mostly it should be a surplus. There should not be any deficit. But if in case if there is a deficit, that should be taken here, and then brought down to the debit side. And then if there is most of the cases it should be carried forward and taken to the credit side. So now this let's see, now this opening balance is brought down as a credit balance, then cash or bank, any additional fund put by the partner if it is required, partners put the money, and interest on capital account and salaries. This already we have learned in the current account, we have learned now exactly the same, and this is actually a combination of this capital account and the current account. It's a combination of this. The both are maintained in one account, that is the thing. So interest on capital, salaries, commission, and profit and loss of the current year. Profit of the current year, and if there is a loss, then it's a loss of the current year. If there is a debit balance, it will be brought down here, drawings, interest on drawings, and then if there is any loss, it will be taken here, and if there is a surplus, it will be carried forward, and if there is a deficit, it will be carried forward here. So then if there is a surplus, it will be brought down to the credit side, the credit balance. So this is the partners fluctuating capital account maintenance method. Now let us move to the other part. I think you have already well. Now we will solve some problems, so that now it will be very easy for you. Let us do some problems. Let us work out one problem, like Anand and Bharat are partners sharing profits and losses in the ratio of 2:3 on 1st April 2020, the capital balance of Anand are 60,000 and Bharat 30,000 rupees. Their drawings are 12,000 and 10,000 respectively. As per the agreement, partners are allowed 10% interest on capital and interest on drawings is to be charged at 12% per annum. Anand gets salary 2,500 per month and Bharat is entitled to get a commission at the rate of 3% on net sales. That sales is 5 lakhs. The firm earns a profit of 60,000. Now prepare partners capital account under fixed capital method and fluctuating capital method. First, let us do a fixed capital method. Fixed capital method, I told you, we will maintain two types. So, what are the things? Now, what is their capital balance? Anand 60,000 and Bharat 30,000. Just see. First April, the balance brought down 60,000 Anand and Bharat 30,000. And this remains the same. This will not change. So, at the end of the year, this is 2020 and 31st March 2021, this balance carried down to next year, 60,000 Anand and Bharat 30,000. See, and then the next year, the next accounting year, 1st April 2021, the balance brought down 60,000 Anand and 30,000. So, under this fixed capital method, this current account, this fixed capital method, this account will not change. Now, whatever the transaction means, other transactions are told, no, means like drawings and salary, commission. These are we already told. It is written here. So, those adjustments are done in the current account, partner's current account. So, now there is no balance brought down. So, now what is interest on capital? Let us see what is the working. So, interest on capital, so it is allowed, interest on capital is allowed. As per the agreement, partners are allowed 10% interest on capital. So, 10% interest on capital are allowed. 60,000 and 30,000 is interest is 10%. So, interest is equal to 60,000. 10% of 60,000 is 6,000 and 30,000 10% is 3,000. So, now that is taken here, interest on capital 6,000 and 30,000 in the current account it is taken. Now, what is said salary? Salary, only Anand gets salary 2,500 per month. That means 2,500 multiplied by 12 is equal to 30,000. So, salary 30,000. Anand gets a salary of 30,000, 2,500 per month. But Bharat is not allowed salary. But whereas Bharat is entitled to a commission of at the rate of 3% on net sales. So, what is the net sales? 5 lakhs. So, 3% of 5 lakhs, that is 15,000. Now, commission to Bharat, that is 5,000 is a sale, commission on sales, 3% on sales, net sales. So, sales 5 lakhs hai, uska 3% 15,000. So, Anand gets a commission of 15,000. Now, what is the next adjustment? The commission and 3% on net sales. Now the sharing of the profit and loss account. The firms earns a profit of 60,000. So, it is shared at the ratio of 2:3. So, let us see how does it work. So, distribution of profit 2:3, 60,000. So, it will be distributed 2:3. It will be worked like this. It's a 24,000. That means 60,000 multiplied by upon 5, 60,000 upon 5 multiplied by 2, because this is two part is given to Anand and three part given to Bharat. So, 2:3. So, this is 24,000 to Anand and 36,000 to Bharat. So, let us see. So, 24,000 to Anand profit and given to Bharat 36,000. So, now what is the commission? Drawings 12,000 and 10,000 respectively. Okay, now interest on drawings is also given 12%. So now let us see, drawings 12,000 Anand and 10,000 Bharat. Now interest on drawings is charged at the rate of 12%. So interest on drawings needs to be calculated. Interest on drawings 12,000, Anand withdrawn 12,000 and Bharat withdrawn 10,000, is now 12%. So the date of drawings is not given. When the date of drawings is not given, it is taken for 6 months. So it is as per the, it is taken as per the Indian Partnership Act 1932. Because since the date of drawings is not, it is guided by the Partnership Act. So if the date of drawings is not given, then the drawings will be taken as interest on drawings will be taken for 6 months. So this all things we have learnt earlier, means these terms. So now 12% ka 12,000 ka 12% is 1,420. So 6 months it is 720. So same way 10,000 ka 12%, 1,200. 1,200 ka 6 months ka 600 rupees. So this way it is working. So this all are very easy, and you can, this is a simple mathematics. Okay, hope you can understand this. So now the interest on drawings is 720 and 600. Let's see, now this total of this credit balance is 60,000 and the total of this is 12,720. So this is more. So out of this, this credit balance is more. So this is carried forward, the difference. So this carried forward at the end of the year, 31st March 2021, 47,270. And here also this is 54,000 and this is 10,600. So the credit side is more. The credit side 54,000 minus this 10,600, this is 43,400. So this is carried forward. So next year, so the next accounting year, 1/4/2021, the balance brought down to the current account, again the current account 47,280 and 43,400. This balance is carried forward. Now if let us work out the fluctuating capital method. Fluctuating capital method. Let us work out the fluctuating capital method. So first, see, just take this like this. See, this balance brought down, this current under the fixed method we have taken this now. So this is a combination of this thing. First the balance brought down 60,000, 30,000, and then interest on capital. These workings we already taken here, is shown here. Don't have to work again. Then interest on capital taken, salary taken, commission taken, and then the profit that is also we worked out here. So it is not necessary to work out again. So 24,000, 30,000, this is total is 1,20,000 minus, and whatever the drawings, it is drawings and interest on this thing, then the balance will be carried forward to 1,07,280, and here 84,000 minus 10,600, 73,400. So that from the in the next year beginning 1/4/2021, 1st April 2021, the balance brought down 1,07,280 and 73,400 for Bharat. So now just see the thing. So here the 47,280 is the current partner's current account balance. What is here? It is 60 plus 47. This is the amount. So this is a combination of this. Same way, what is a balance carried forward? 43,400. What is a fixed amount? 30,000. 30 plus 43,700, 73,400. So that is the thing, 73,400. So this is a combination of the things. Now there are example 1, 2 and example 3 and example 4 is also given. Example 4 types of examples are given here, but when it is, if it is going more than 40 minutes, and it will be bit difficult to just grasp all the things. So we just stop it here. Okay, now I think you have understood this. Now let us move to the other part, because if it extends, it's more than 30 minutes, it will be just difficult to understand all the things. So these things, it is very easy. You can just go through again and again, do some examples. Okay, and we have a working of that notes, and it's are very vast, so it cannot be means just put all the things together and it will take hours and hours. So we don't want to do that, and that you can take separately. Okay, now this is the thing. I hope you understood this. Fixed capital method, how to maintain a fixed capital method. Under fixed capital method, fixed account is capital partner capital account, and a current account is opened. A current account, all the adjustments are made passed through the current account, and a fixed capital account is maintained. Both these are maintained in the under fixed capital method, and there is the fluctuating capital method, and under this method one capital account is maintained, and all the transactions are done through the same account only. So it is almost the combination of fixed and current account. When it is maintained in one capital account, it is a fluctuating capital. The term itself says the balance. See, for example, the balance brought down is 5 lakhs and 5 lakhs each. Okay, so for example, what is that? 60,000. 60,000 and 30,000. See, now under fluctuating capital method, under fixed capital method, this is the balance is same. It is carry forward here, and this is a balance brought down to the next year, and the profit, loss, adjustments, everything is done through here. Whereas just see in the fluctuating method, the opening balance is 60,000, whereas the closing balance is 1 lakh. The opening balance of Bharat is 30,000. The closing balance of Bharat is 73,000. See, just see this. So there is a means just fluctuating. The balance keep fluctuating. That is the term itself. It is saying that like that. So now let us move to the. Let's wind up this because this is taking a long time. Okay, now let us wind up this class today. I hope you have understood that. Please read it again and again. Now this is a motivation sentence. I request all my students to study regularly. I keep repeating this. If you don't understand, watch again and again. Please do that, because I want my students to score full marks in the subject or just close to 100% mark, and it's possible. Few of my students has shown that, they have proven that. So most important, you all must have to make a strong base in the subject that decides your career. आगे जो आपको जो डिसाइड करना है कैरियर, वट एवर मीन्स यू वांट टू डू द बेटर कोर्स और एनी अदर स्टडीज़, हायर स्टडीज़ के लिए, दिस विल हेल्प यू बेटर. सो यू मस्ट बी वेरी सीरियस एंड सिंसियर टू योर स्टडीज़, डेडिकेट, देन मेक योर कैरियर. प्लीज रीड again and again, learn and practice to achieve your life goals. It is not that much difficult. When I guide, you do the practice, it is easy. It will be very easy. Now my message: help each other to grow together for a better India. See, the thing is that now please pass these videos and messages, some short ads and all this thing to others, so that now this can reach to many people. Some people may be doing, means poor students may be doing correspondence courses, postal education, distant education. So it will be helpful for them. We cannot trace out where they are. So when we pass it, they may, this message may reach to them, these videos may reach to them. So they can use the advantage, they can take it. And some students may not be able to afford the tuition classes. They can also use these classes. It will be a blessing for them, for the distant education students and postal education students. Correspondence classes, and the students can take that advantage. It will be a blessing for them. And those students who cannot afford the classes also, it will be very helpful for them. So please share the message. I request you all to share my these videos and also the short ad videos to reach more and more people, so that many students and public can take the benefit. There are some other means that other beneficial classes, videos, classes or lectures are also uploaded on my videos for the benefit of the many public, businessmen and others, how to motivate business, how to start a business, and what are the invoices, what is the term, and many things are I uploading for the general knowledge, accounting and finance knowledge purpose. Okay, so that also for them also it will be helpful. It will help many people. Hope you have understood this. Thank you for your attention.